Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today's Thursday. It's April 28th. It's about 7:53 in the morning. The market's going to start up in about an hour and 37 minutes to be exact. Now, as you can see here, the Nasdaq is up big, 268 points. That's huge. Just to give you a perspective, the Dow and the Nasdaq look like they're up about the same, but the value of the Dow is like 33,000. This is 13,200. So this is just to give you a significance. The reason for that is you've got Facebook reporting, you've got all the techs reporting this week. It's a volatile period. Now, I'm getting more and more bullish on the market, and I'll show you why in this broadcast. The biggest reason, and I want to explain this to you, is this. Look at the Nasdaq 100. This is the top 100 Nasdaq stocks. These are the stocks that have been giving us the biggest headache in the last year, maybe 6 months. But as you can see here, we peaked on momentum levels in December of 2020. We're right now right at the level, or just a hair, literally a hair above the level we were during COVID, a hair above the level we were in December of 2018. Both of these environments, or at least the COVID environment, was worse than the current environment. But this is 2008 crash right here. So my point is, for everybody who's waiting for a big meltdown in a market to come down, it already did. It already did. Now, the Dow's down about 9% for the year, or from the highs. Typically, a bear market is when the Dow's down 20% from the highs. It's only down half. So I think people are getting a little bit ahead of themselves, especially when you take a look at this momentum level. Another factor that's very, very instrumental is the Dow Jones. And if you look at the Dow Composite, 51% of stocks are trading above the 200-day moving average. You can't have a bearish market when you have 51% of stocks trading above the 200-day moving average in the Dow. Even the Nasdaq Composite, it's down only 16%, 15 to 16%. So we are not, I repeat, we are not in a bear market. Now, in terms of economy, this is going to be very important, and the consensus is all over the place. This is going to be instrumental. Not as instrumental as it usually is, because we're in the middle of literally the biggest tech earnings season, in probably the most important one for the market in the last 2 years. But this GDP is very important, because this will give us a good idea if the economy is humming along or not. If the economy is humming along, basically, if this number is really, 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 really strong, like towards the 1.9 area, then the Fed can say, hey, we really need to do something now about this bond market, and we need to get aggressive. Maybe we'll raise 3/4 of a point, whatnot, of a basis point, 0.75 basically. Or if it's on the low end, they may say, hey, we can't really do anything, and that would cause the bond market to rally. Now, what's interesting is the bond market stopped going down, which means the bond market, the long bond, has assimilated all of its rate hikes within the bond market, especially for the last 2 weeks, because prices are not going lower. And that's very significant. Now, I'll probably end up chewing my tongue for this, and we'll probably see a breakdown. But the fact that we've been going sideways now for 2 weeks is telling me, even though the Fed has been saying we're going to keep raising rates, it's telling me that the bond market is assimilating it, and it's already pricing it in. And for now, it's saying enough is enough. And that's a bullish sign for the stock market. Aside from that, the put-to-call ratio is still inflated. We're still above 1. Day before yesterday, we were at 130. Then we were at 113. And I think we're still at 113. The point is, till this comes down, the market is going to be oversold, and that means there's more upside potential. Volatility started declining yesterday. We went from 33 all the way to 29, and I believe we're going to come down all the way to 20 over the next couple of days. Also, if you look at the Dow right now, if you look at the price levels, it looks like we bottomed out near the current area. And it looks like we're going to go higher, at least till the 200-day moving average. So I'm expecting higher prices over the next couple of sessions. And we are pre-open up 269 points. Now, let's talk a little bit about global economy, and we'll go on with our levels from there. Quarterly earnings reports from America tech heavyweights are on tap. Twitter, Apple, Amazon, they report today. So it's going to be a really, 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 really interesting day, following strong results from Facebook and Microsoft, which is one of the reasons why the market is holding up so well. Oil prices dipped as European countries united in condemning a decision by Russia to cut natural gas shipment to Poland and Bulgaria. That's huge. As a failed attempt to divide the West in its support for Ukraine. That's not going to work. Russian escalation in the economic standoff of sanctions and counter-sanctions could force targeted countries to ration gas, dealing a fresh blow to economies strapped by rising prices. This is why I say don't write off energies just yet. Natural gas prices surged 24% in Europe. That's huge, huge, huge. Japanese officials have expressed concern over the yen's weakness at a time when costs for imported oil, gas, and other commodities are soaring. But the Bank of Japan doesn't want to raise their rates. But the Bank of Japan has indicated it intends to keep lending conditions ultra-lax to help support the sluggish economy. I don't know if they're right or if America's right, but we'll find out soon enough. But if their inflation is going to keep getting higher, and if the yen's going to keep dropping, and if they're not going to take action via the yen, I don't know what's going to happen there. It's not a good situation to be in. Chinese benchmark were higher amid a flurry of company commentary. They're always commentary, pandemic, shutdowns. There's always something going on in China. Strict COVID lockdown measures in China have added concerns about slowish growth, disruption, the flow of industrial goods, and other business activity in Shanghai, home of the world's busiest port. So again, logistical nightmares. Remember, they have to export stuff out of there. It's a big, 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 big headache. Now, looking at the major sectors, which we will do right now, probably won't be a big surprise which is leading and which is lagging, right? Energy, consumers, utilities. No change for now. But notice something. Consumer discretionary and technology are finally next to each other. Basic materials and industrial are finally next to each other. Consumer staples and utilities are finally next to each other. And notice that's happening right when momentum levels, right? Let's see here. Where's my momentum levels? That's happening right coincidentally when momentum levels are bottoming out. As I showed you, look at that. Markets get fragmented on the way up. They get defragmented and come together on the way down. That's the first time in a long time I've seen technology and consumer discretionary, material and industrial, consumer staples and utilities and energies are pretty much up there next to each other. Very, very, very significant. Markets are starting to come together. They're starting to not be as disjointed. Energy looks like it's ready to go up again from these levels. Utilities looks like it can come down a little bit more. Real estate doesn't look all that great. Consumer discretionary looks like it's ready to bounce higher. Industrial looks like it's ready to bounce higher. Basic material looks like it's ready to bounce higher. I don't know about communication services. It'll probably just be a dead cat bounce. Financial looks like it could start coming back up, and technology looks like it can be due for a bounce. The question remains, how stable is the stock market? And again, we'll have to see, but right now I like what I am seeing. Now, since we are talking about the most important ETFs today, and I want to give you an option with it, I'm still liking consumer staples. And I'll explain to you why I'm liking consumer staples. If you look at, and I've been explaining this since day one, but I want to show you this. It's important. Look at the stocks leading right now. Remember about a month and a half ago it was all energy? Well, now you've got a lot more basic materials in there. For example, Nucor is a basic material. Mosaic is a basic material. CF Industries is a basic material. McKinson's a basic material. ADM is a basic material. So you've got a lot more basic materials in here, not just energies. And when I look at materials, let me just here. When I look at basic materials, I'm liking what I'm seeing right now. And we're right at the 200-day moving average. And I think we're going to bounce off of the 200-day moving average. But I really, really like basic materials right now. And just to tell you another one, I like consumer staples a lot. Those are the two sectors I would be looking at. So I would be looking at basic materials and consumer staples. I think those two sectors are going to go higher. So right now, what we want to do is we want to buy consumer staples. It's the strongest sector, and it's pulling back. It had 1, 2, 3, 4, 5 days to the downside. I think it's time for it to come back up. And right now, I would be looking at the September expiration. It's got plenty of time. It's got plenty of open interest. Look at this. I would go to, look at these, look at the open interest. It's very liquid. The spread will be like 10 cents maybe. I would probably go with the 79 or maybe an 80. Look at that. It's about 260, 280, had 35 contracts, 877. You can't go wrong. Definitely recommend something in this ballpark for consumer staples and for basic materials. Oops. What am I doing here? What's the ticker here? XLM. XLM. Oops. XLM. Isn't that basic? I should know this by now. XLB. Sorry, XLB. XLB. My tickers get confused. I look at too many tickers. And for basic materials, I would also be looking for September. And for that one, I would be looking, actually, that one's not as liquid. So we want to go to August on that one. Yeah, there you go. And you can get the 85 or 86, somewhere in this ballpark. I would wait for them to open. You can probably get a better bid. You can even, no, I wouldn't go to 6, but I would go to 8. Yeah, I wouldn't go below August. But I would look at August and I would look at the 85, 86, 87. Those would be the top ones. The bottom line, keep your eye on the GDP report, keep your eye on tech, and keep your eye on momentum levels. These momentum levels are telling us a real big story. Remember, we are near the bottom, not near the top. And it looks like we're going to go higher very, 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 very soon, especially if these earnings are better than expected as a whole. Now, I've got something very important for you, and I want you to pay attention. Too many traders have missed out on massive, massive gain opportunities. Champion trader Chuck Hughes has shared in the past. That ends this week. Look, the S&P 500, it's been swinging all over the place. I mean, that's an understatement. And the markets have been difficult. While everyone else is glued to the market noise, doing this, buy, sell. Oh, everybody. Chuck just picked up on what he calls the most convincing market signal he's ever seen. As a matter of fact, there are 3 major events leading to him to believe in a handful of new stocks that are primed for takeoff. And I'm there too. You guys got to see this. I'll show you some really good stuff that'll really blow your socks off. This is good stuff. Click the link below, learn more about these 3 major events, and watch the presentation. Tomorrow, biggest winners, biggest losers, what to expect the following week, and a full recap. People love my weekend reviews. Don't miss out. Follow the link in this video to check out Chuck's takeoff. And I'll be there, and I'll go deep into these momentum levels. I'll talk about whether there's going to be a recession, all of it. You don't want to miss this out. It's really, really important. People loved it. We had people stay all the way till the end when we presented it the other day. Follow the link. If you're watching on YouTube, go to the YouTube Wealth Press channel and go to the descriptor, and the link is below there. Have a great day, everyone. Bye.